$1 billion. Poof, just vanished from the crypto market. And look, this wasn't just another volatile Tuesday. No, this was a calculated move, a trap that has wiped out a very specific class of investors. So we're launching an urgent investigation to uncover how this billion-dollar trap was set, who fell into it, and what it signals for the future of this bull market. Let's get into it. $1 billion. Just let that sink in. That's the staggering amount of realized losses that hit the market in a single 72-hour window. I mean, this wasn't some slow bleed, it was a sudden, brutal financial event. So the first question in our investigation has to be, whose $1 billion was it?
All right, to solve this mystery, we've got to start with the victims. Now, this wasn't thousands of small retail traders getting shaken out. The on-chain data, that public ledger of all transactions, it gives us our first major clue. And it points to a very, very specific group of investors. So let's meet the new whales. The data shows these are investors with over $1 million who, for the first time ever, bought Bitcoin as it was soaring past $110,000. They were driven by that classic FOMO, the fear of missing out. But as soon as the price dipped to a key support level, that price floor where buyers usually step in, they panicked. They just sold, locking in that $1 billion loss. Ouch. So here's the crucial question. What does an event like this actually mean? Is this just the smart money flushing out the newbies before the next big rally? Or is this the canary in the coal mine, a warning that the bull run is over and a long, cold crypto winter is coming? Believe me, experts are fiercely divided on this one.
And this brings us right to the core conflict that's driving the market right now. You've got two camps, Team Bear and Team Bull, and they're looking at the exact same data and coming to completely opposite conclusions. Let's break down their arguments.
Okay, so on one side you have Team Bear. They see this as a huge red flag, and they're pointing to a classic bearish signal that has just been confirmed. But on the other side, Team Bull is basically celebrating. They call this a capitulation event, that moment of maximum pain when the last of the sellers finally gives up. In their view, with all the panic sellers gone, the path is clear for new all-time highs.
So Team Bear's main piece of evidence is something called the death cross. Yeah, it has a terrifying name for a reason. This is a technical pattern where the short-term price average crosses below the long-term trend, and historically, this pattern has often signaled the start of a really deep and prolonged bear market.
But Team Bull, they completely reject that. They argue this wasn't a technical breakdown, it was a psychological one. They see this billion-dollar loss as a necessary evil. Basically, the market flushing out what they call the dumb money and paper hands. So, in their view, this painful event is actually what the market needed to get healthy again.
So who's right? The bears or the bulls? Well, to find out, our investigation has to look past all the noise and follow the smart money. And that means we need to go whale watching, but we have to make sure we're watching the right whales.
And this is where the story gets really, really interesting. See, it's not enough just to watch the whales. You have to know which whales you're watching. On one side, you have the new whales we've been talking about, inexperienced, driven by fear. But on the other, you have the OG whales. These are investors who've been holding for 5 years or more. Their mindset isn't fear, it's conviction. A conviction that was forged by surviving multiple brutal bear markets. And their actions? They tell a completely different story.
And here it is. This is the single most important clue in this entire investigation. The on-chain data is crystal clear. The most experienced long-term investors, the OG whales, are not selling. In fact, many are using this dip as a buying opportunity. They're actually absorbing the coins that the new whales just panic sold at a huge loss.
The actions of these OG whales bring us to the one number that matters more than anything else right now, $100,000. This isn't just some arbitrary round number. It has become a critical psychological and technical level for the entire market.
Think of this level as the new psychological line in the sand. The consensus is pretty simple. As long as Bitcoin's price holds above $100,000, the bull market structure is still intact. But a sustained break below this level could trigger a much deeper correction. So for now, the bulls are defending it fiercely.
So, after all that, what's the final verdict from our investigation? What can we all learn from this billion-dollar disaster? Well, the events of the last 72 hours have given us a crystal-clear playbook on exactly what not to do.
It really just comes down to two simple rules. First, don't be a new whale. Chasing an asset out of FOMO after it's already had a huge run-up, well, that's a recipe for disaster. And second, remember that time in the market is almost always more powerful than trying to time the market. The billion-dollar losers, they tried to make a quick trade. The OG investors who bought years ago, they're sleeping just fine.
You know, this whole event is just a perfect, if painful, illustration of this classic quote. The market really is a device for transferring money from the impatient to the patient. We just watched it happen with $1 billion in real time.
This billion-dollar whale trap, it wasn't just a random event. It was a test of psychology and strategy. And it forces every single investor to look in the mirror and ask a simple but profound question. Are you the impatient or are you the patient? The answer will likely determine your entire journey in these markets.